You're listening to 59.5 Retirement Chat Radio, powered by My Retirement Exit. Now here's your host, Jenny Jones.
Hello, caller. Welcome to Retirement Chat Radio. Let's start with your name and where you're calling from.
Yeah, Jones. I'm calling from Las Vegas, Nevada.
Hello, Ms. Jones from Las Vegas. What's the purpose of your call today?
Okay, I'd like to first thank Jenny Jones and the Retirement Exit for inviting me on the show or extending the invitation. My question is, why is it that when you retire, they cut half of your insurance that's offered by the company from retirement in half, and then after that, every 5 years, they take another half of it off until you get up to the age of 75, which by that time, there's nothing left to even use in case you need it for a burial or for a funeral. I don't understand that. I'm confused. Then you have to go and get a pre-need policy on the outside to pay for that. So I'm still confused.
Oh my God. Can't believe this is happening. Okay, Mom, that's a good question. Okay, so the OPEB or other post-employee benefits conundrum. Wow. And I had to get that call from my mom. Okay, so listen, did not expect that question. Let's see how to break this down. I may cover this in greater detail on My Retirement Planning TV, which should be a link in the description. I may have to cover this a little bit deeper, but for the sake of time, I will give you an abbreviated version. Okay, let me start with my disclaimer. Please do not take my responses as actual advice, as I only speak in hypotheticals. Please always consult with your own professional advisor, as they are the only ones that know your entire situation. Okay, let's see. To answer that question for a person that came into my office, well, this is Retirement Chat Radio and is included in, it comes to retirement planning. So it is included. All right. So I'll answer that question as it relates to retirement. It sounds as though that person elected to receive life insurance from their employer when they separated from service. Well, the good news is they had insurance. The bad news is any type of group insurance from an employer is usually a term life policy. And so term, if you don't know, is good for only a term, right? So having worked or studied life insurance intensely in my youth for over the last 20 years, it is said that 99% of all term policies almost never pay out. That's why term is so inexpensive. It never pays out because it really only covers for a term. So if everyone jumped in the pool or on a group life insurance policy, so all of your employers got into it to, let's say, 2,000 people are in the policies, they're all paying a small amount. But out of those 2,000 people, they may only have to pay out, a couple of people that may not make it to their life expectancy, right? They play the law of numbers on that when it comes to group and or term policy. So there are several reasons why this is perceived to be the case. 99% of them don't pay out. One reason being that most people may miss a payment, thus voiding the contract altogether with the insured, thus canceling the insurance policy. So the insurance company will cancel the policy if a premium payment is not made. You could be paying on a policy for 15 years and miss one payment. And sometimes they will give you an extension, but if you miss that, the entire contract is canceled and or expired at that particular point. So the other most popular reason is most people, quite frankly, just outlive the term policy, right? This appears to be the case as explained in the call. Right? How you say the longer you have it, the more they cut it in half. With each significant milestone date, the policy payout is reduced. Why? Because the closer you get to your mortality date or the window, the more likely the insurer would have to write a check for the death benefit, for the entire death benefit. Okay, so let me see. The challenge in retirement planning is okay, so let me start this over. So the challenge in retirement planning is if you include employer group life insurance in your planning, this is the portion that may fail you if you continue to live, or we all continue to live, but if you continue to live longer, then the more this particular setup may fail you in the end, because the longer you're on that insurance policy, as you're experiencing now, it decreases, right? So let's put it this way. So insurance is based on two factors. Well, there's a lot more factors, but the two biggest factors are age and health, right? The older you get, the more insurance costs. And unfortunately, the health does not get any better. You may have retired and you're at a certain age, you have one set of pills that sit on the top of your dresser. Then the longer you live in, you start getting these more and more pills. That's a whole nother story for a whole nother podcast day. So the health risk now becomes something that is considered in the underwriting of an insurance policy. So as you get older, that's why insurance costs so much more when you try to get insured at an older age, because you're older, right? And your health is not going to get better as you age. It just doesn't work like that, right? It's not specific. It's supposed to work like that. So I try to include this calculation when I'm working with most of my clients, but for some reason they hate to include it or do not like talking about it at all. They don't like talking about insurance. I'm like, listen, that's a part of your retirement plan, because you have to plan for the unexpected. What if you lose a spouse? Everything's is fine and dandy when both people are receiving Social Security, but when Social Security check goes away, what then happens? But for some reason, they don't like talking about it. And I have to just put a statement in their portfolio, in their folder, and say, hey, they did not want to talk about it. But we must, as planners and advisors, must talk about insurance as it protects your entire plan. It's the transfer of risk. It's what it is. This is a bigger risk to your retirement plan than most people think, right? Insurance is one of those things that once people figure out how much, or if they actually need, or how much they actually need, or figure out how it works, it's just too late to do anything about it, unfortunately. So to summarize the answer of the caller, group policies are cheap or inexpensive because they are term policies and designed only to last a short term. Really no more than 20 to 30 years at most. Anything beyond that is usually returning to you the amount of money or premium payments that you put into the actual contract, or a factor close to that at best. That's hopefully with a reputable insurance company, if you're lucky. I would not recommend this option to my clients unless they know their health issues that may reduce their life expectancy. So if you know you're sick, you know you got cancer, you know your family has cancer, everybody's had cancer, which is unfortunate. These are things that we must talk about. Then you say, well, my chances of getting them, because they're hereditary or blood clots or something, maybe I need to stay into the group pool or the group insurance and try to mitigate my risk by using the group insurance. All right. So that's just one thing. What I love about planning retirement plans is no one person, family, or couple is ever the exact same. There's always slight variations. So as always, seek out a financial professional who knows everything about you before giving you advice. They do this by taking a financial intake form where they know where all of your assets are. This gives them a full picture so that the advice they provide will be sound. Please like and subscribe not to miss another episode, and look in the descriptions for any links or references that I may have made to this segment. Thanks for your call, Miss Jones, Mom. All right. Next caller, please.